all the way up to 7,100% Russell 2000 iShares and 8,500% SPDR Energy shares. Could there be speculation going on here? Yes, specialized ETFs are diversified, but only in their narrow arenas. Owning the semiconductor industry is not diversification in any usual sense, nor is owning the South Korean stock market. And while sector ETFs themselves frequently have the lowest expense ratios in their fields, they could run 3 to 6 times the level of the lowest cost all-market index funds. What is more, sector ETFs carry not only brokerage and trading costs, but are often sold as parts of actively managed fund portfolios with advisor fees of 1% or more, or in wrap accounts with annual fees of 1.5% to 2% or more. The net result of these differences is that sector ETFs as a group are virtually certain to provide returns that fall well short of the returns delivered by the stock market. Perhaps 1% to 3% a year is a fair estimate of these all-in costs, many times the 10 to 20 basis point cost of the best classic index funds. It is not a trivial difference, for no matter how often derided or ignored, the tautology remains that sector funds must and will earn a net return equal to the gross return of that sector, less intermediation costs. A double whammy. Betting on sectors as they grow hot, emotions, and paying heavy trading commissions and fees, expenses, are sure to be hazardous to your wealth. But whatever returns each sector ETF itself may earn, the investors in those very ETFs will likely, if not certainly, earn returns that fall well behind them. For there is abundant evidence that the most popular sector funds of the day are those that have recently enjoyed the most spectacular recent performance, and that such after-the-fact popularity is a recipe for unsuccessful investing. The lesson we learned in Chapter 5, that mutual fund investors almost always do significantly worse than the funds they own, is almost certain to be repeated in ETFs. And because the ETFs focus on ever narrower market segments and trade at a far more rapid rate, the damage is apt to be far worse. To illustrate this point, let's look at the record of the 107 ETFs with 3-year records through 2006. The actual returns earned by their investors lagged the returns reported by the funds themselves in 66 cases, nearly 2/3 of the list. In many cases, the lag exceeded 10% of return per year, a loss of capital equal to some 30% of the amount invested in them. The Spider Materials ETF sector took the cake, with a gap of 30.3% per year. The sector earned a positive return of 16%, while its investors suffered an annual loss of 14.3%. For investors in the Russell 1000 Index ETF, the negative gap was 17% per year. The MS Technology Index ETF, 11.9%. The Taiwan Index, 10.9%. In the Semiconductor ETF, 10.8%. And the Midcap Growth Index ETF, 10.7%. Handle with care should be the first warning on the ETF label, though I have yet to see it used. And so we have a double whammy. The near inevitability of counterproductive market timing, emotions, as investors bet on sectors as they grow hot and bet against them when they grow cold, combined with those heavy trading commissions and fees, expenses. Together, these two enemies of the equity investor are sure to be hazardous to your wealth, to say nothing of consuming giant globs of your time that could easily be used in more productive and enjoyable ways. The explosive emergence of the ETF from its humble beginnings in 1992 to its prominent status today has been a boon to fund managers, investment advisors, financial entrepreneurs, arbitrageurs, speculators, and traders. In 2006, ETFs were also at the cutting edge of a variety of the kind of market-beating strategies, at least in retrospect, described in the previous chapter. The choice of the ETF structure by these entrepreneurs, rather than the standard mutual fund format, would seem to belie the fact that their fundamental indexing approach may take decades to prove itself, if indeed it does so at all. These new indexes, as noted in the previous chapter, are based not on traditional market capitalization weighted indexes, that is, S&P 500, Dow Jones Wilshire Total U.S. Stock Market, but on fundamental factors such as dividends, or some combination of revenues, profits, cash flow, etc. These ETFs describe themselves as the new paradigm and promise, or at least strongly imply, that they will outpace the classic index fund. Yet by choosing the ETF format, they imply even more strongly that actively buying and selling the funds will lead to even larger short-term profits. All things considered, the burgeoning growth of ETFs is an entrepreneur's dream come true. They offer the excitement of a new idea, massive publicity, and the marketing flexibility of the fund industry's asset gatherers to focus on whatever sectors are hot and whatever strategies have paid off in the recent past, all the better to attract the capital of performance-hungry investors. Not only do ETFs generate soaring assets and soaring fees to the managers, but active trading in ETF shares generates heavy sales commissions for brokers. But is it too much to ask whether these index funds nouveau are an investor's dream come true? Do investors really benefit from the ability to trade ETFs all day long in real time? Is less diversification better than more diversification? Is trend following a winner's game or a loser's game? Are ETFs truly low cost when we compare their expense ratios, much lower than actively managed funds, but generally many times higher than the leading traditional index funds, with the sales commissions paid to brokers on each transaction? Is buy and sell, often with great frequency, really a better strategy than buy and hold? The classic index fund was designed to capitalize on the wisdom of long-term investing, holding the market portfolio for an investment lifetime with the broadest possible diversification at the lowest reasonable operating expense, minimal portfolio turnover costs, the absence of sales loads, and optimal tax efficiency. What can we say of these index funds nouveau? In general, they offer far less diversification, far more operating expenses, repeated sales commissions, and, for the lucky investor who trades them profitably, substantial tax inefficiencies compared with their classic predecessors. Held for only a few years, or even a few weeks or months, and often chasing bygone performance, investors in these index funds nouveau are too often engaging in the folly of short-term speculation. On the broad spectrum that lies between advancing the interests of the business and the interests of the clients, where do ETFs fit? If you are making a single large initial purchase of either of those two versions of classic indexing, the SPDR or the Vanguard Total Stock Market ETF, at a low commission rate and holding them for the long term, you'll profit from the low expense ratio and may even enjoy a bit of extra tax efficiency. This is the very indexing strategy that is the theme of this book. But if you trade them, you're ignoring the relentless rules of humble arithmetic that are the key to successful investing. If you like the idea of sector ETFs, use the appropriate ones. Don't trade them, and use them in the right way, sparingly, and only to diversify your portfolio. Let me now answer the question I asked at the outset of this chapter. What have they done to my song, Ma? As the creator of the world's first index fund all those years ago, I can only answer, they've tied it up in a plastic bag and turned it upside down, Ma. That's what they've done to my song. In short, the ETF is a traitor to the cause of classic indexing. I urge intelligent investors to stay on the course with a proven strategy. While I can't say that classic indexing is the best strategy ever devised, I can reassure you that the number of strategies that are worse is infinite. Don't take my word for it. Listen to what Don Phillips, managing director of Morningstar, has to say. Indexing has served investors well, but there is a dark side to indexing that investors should not ignore. The potential for harm to investors increases as index offerings become more specialized, which is exactly what has happened in the world of ETFs, which have progressively become more costly and more volatile over the past decade. In the right hands, precision tools can create great things. In the wrong ones, however, they can do considerable damage. As ETFs become increasingly more potent, the penalty for their misuse grows more extreme. In creating more complex offerings, the index community has found new revenue sources from very specialized tools, but it has done so at the risk of doing considerable harm to less sophisticated investors. The test of character facing the index community is whether it ignores that risk or steps up and tries to mitigate it. The continued good name of indexing lies in the balance. From Jim Wyant, editor of the Journal of Indexing. I have always found it ironic that indexing, like most everything else in the world of finance, comes in waves. In an early article I wrote in this publication, I noted that a careful comparison of returns and fund inflows showed that even asset growth in the erstwhile Vanguard 500 was driven by investors chasing returns. Hedge fund indexes, microcap indexes, dividend indexes, commodities indexes, China indexes, and enhanced indexes are all flavors of the month. And I'll give you 3 guesses as to what all of these indexes have in common. 1. Chasing returns. 2. Chasing returns. Or 3. Chasing returns. And this move toward enhanced indexing. Call me a cynic, but if you believe in indexing, then you know there is no free money, and you've got to believe that active is active. It's only a matter of degree. Ultimately, the push toward enhanced indexing is about enhancing the bottom line for managers, something all the major index players have been doing with great success of late. But it's important for us to keep our eyes on the ball and remember what makes indexing, well, indexing. Low fees, broad diversification, hold, hold, hold. Don't believe the hype. Try to beat the market in any manner, and you're likely to get beat by about the cost of doing it. And now listen carefully to the warnings from 2 senior officers of one of the major sponsors of ETFs. Chief Executive: for most people, sector funds don't make a lot of sense. Don't stray too far from the market's course. Chief Investment Officer: it would be unfortunate if people focused pinpoint bets on very narrowly defined ETFs. These still involve nearly as much risk as concentrating on individual stock picks. You're taking extraordinary risk. It's possible to take a good thing too far. How many people really need them? Chapter 16. What would Benjamin Graham have thought about indexing? You heard it here. The first edition of The Intelligent Investor was published in 1949. It was written by Benjamin Graham, the most respected money manager of the day, and co-author, with David Dodd, of Security Analysis, a remarkable and scholarly tome originally published in 1934. Whether or not The Intelligent Investor was the first book of its kind, it was surely the best, comprehensive, analytical, perceptive, and forthright. A book for the ages. While Benjamin Graham is best known by far for his focus on the kind of value investing represented by the category of stocks he describes as bargain issues, he cautioned that the aggressive investor must have a considerable knowledge of security values, enough, in fact, to warrant viewing his security operations as equivalent to a business enterprise. It follows from this reasoning that the majority of security owners should elect the defensive classification. Why? Because the majority of investors do not have the time or the determination or the mental equipment to embark upon such investing as a quasi-business. They should therefore be satisfied with the reasonably good return obtainable from a defensive portfolio, and they should stoutly resist the recurrent temptation to increase this return by deviating into other paths. While the index fund was not even imagined in 1949, he was certainly describing the very approach that this precedent-setting fund would later follow. Coincidentally, it was also in 1949 that an article in Fortune magazine introduced me to the mutual fund industry, inspiring me to write my 1951 Princeton senior thesis on mutual funds. In my thesis, I even hinted at the index fund idea, writing that mutual funds can make no claim to superiority over the market averages. For the defensive investor who required assistance, Graham originally recommended professional investment advisors, who rely on normal investment experience for the results, and who make no claim to being brilliant, but pride themselves on being careful, conservative, and competent, whose chief value to their clients is in shielding them from costly mistakes. He cautioned about expecting too much from stock exchange houses, arguing that while the Wall Street brokerage fraternity has probably the highest ethical standards of any business, it is still feeling its way toward the high standards and standing of a profession. A half-century later, the quest remains far from complete. He also noted, profoundly if obviously, that Wall Street is in business to make commissions, and that the way to succeed in business is to give customers what they want, trying hard to make money in a field where they are condemned almost by mathematical law to lose. Later on, in 1976, Graham described his opinion of Wall Street as highly unfavorable, a Falstaffian joke that frequently degenerates into a madhouse, a huge laundry in which institutions take in large blocks of each other's washing. Shades of Harvard's Jack Meyer, from whom we have earlier heard, and Yale's David Swenson, whom you'll meet in the next chapter. In that first edition of The Intelligent Investor, Graham commended the use by investors of leading investment funds as an alternative to creating their own portfolios. He thought the term investment trust was inaccurate and the term investment company ambiguous. Of course, he was describing what we now have come to know as mutual funds, though that term too is ambiguous and far from forthright. Graham described the well-established mutual funds of his era as competently managed, making fewer mistakes than the typical small investor, carrying a reasonable expense, and performing a sound function by acquiring and holding an adequately diversified list of common stocks. But he was bluntly realistic about what fund managers might accomplish. He illustrated this point in his book with data showing that during 1937 to 1947, when the Standard & Poor's 500 index provided a total return of 57%, the average mutual fund produced a total return of 54%, excluding the oppressive impact of sales loads. The more things change, the more they remain the same. Graham's conclusion: the figures are not very impressive in either direction. On the whole, the managerial ability of invested funds has been just about able to absorb the expense burden and the drag of uninvested cash. In 1949, of course, fund expenses and turnover costs were far lower than in the modern fund industry. That change explains why, as fund returns were overwhelmed by these costs in the recent era, the figures for recent decades were impressive only in a negative direction. In a later edition of The Intelligent Investor, written in 1965, Graham's confidence that funds would produce the market's return, less costs, was somewhat shaken. Unsoundly managed funds, he noted, can produce spectacular but largely illusionary profits for a while, followed inevitably by calamitous losses. He was describing the so-called performance funds of the mid-1960s go-go era, in which a new breed that had a spectacular knack for coming up with winners, managed by bright, energetic young people, promised to perform miracles with other people's money, but who have inevitably brought losses to their public in the end. He could have as easily been presciently describing the hundreds of risky new economy mutual funds formed during the great bull market of 1998 to 2000, and their utter collapse in the subsequent 50% market crash that, doubtless inevitably, followed. Graham also would have been appalled not only by the enormous 100% plus increase in those once reasonable fund expenses, but also by the incredible increase in stock trading by mutual fund managers. During Graham's era, portfolio turnover ran to about 15% per year. It now averages more than 100%. Graham would surely and accurately have described such an approach as rank speculation that flies directly in the face of his deeply held investment principles. His timeless lesson for the intelligent investor, as valid today as when he prescribed it in his first edition, is clear. The real money in investment will have to be made, as most of it has been made in the past, not out of buying and selling, but of owning and holding securities, receiving interest and dividends and increases in value. His philosophy has been reflected over and over again in this book. exemplified in the parable of the Gotrocks family in Chapter 1, and the distinction between the business market and the expectations market in Chapter 2. Owning and holding a diversified list of securities? Wouldn't Graham recommend a fund that essentially buys the entire U.S. stock market and holds it forever, patiently receiving interest and dividends and increases in value? Doesn't his buy and hold philosophy, as well as his admonition to strictly adhere to standard, conservative, and even unimaginative forms of investment, eerily echo the concept of market indexing? When he advises the defensive investor to let it, choosing the best stocks, alone, and emphasize diversification more than individual selection, hasn't Benjamin Graham come within inches of describing the modern-day stock index fund? Late in his life, in an interview published in the Financial Analyst Journal in September-October 1976, Graham candidly acknowledged the inevitable failure of individual investment managers to outpace the market. Again, coincidentally, the interview took place at the very moment that the public offering of the world's first mutual index fund, First Index Investment Trust, now Vanguard 500 Index Fund, was taking place. He was asked, "Can the average manager obtain better results than the Standard & Poor's Index over the years?" Graham's blunt response, "No." Then he explained, "In effect, that would mean that the stock market experts as a whole could beat themselves, a logical contradiction." The interviewer's next question was whether investors should be content with earning the market's return. Graham's answer, yes. Not only that, but I think they should require approximately such results over, say, a moving 5-year average period as a condition for paying standard management fees to advisors. All these years later, the idea that earning your fair share of the market's return is the winning strategy is the central theme of this little book. Only the classic index fund can guarantee that outcome. Finally, he was asked about the objection made against the index fund, that different investors have different requirements. Again, Graham responded bluntly, "At bottom, that is only a convenient cliché or alibi to justify the mediocre record of the past. All investors want good results from their investments and are entitled to them to the extent that they are actually obtainable. I see no reason why they should be content with results inferior to those of an indexed fund or pay standard fees for such inferior results." More than half a century ago, in his introduction to The Intelligent Investor, Benjamin Graham cautioned that many of the financial instruments of his day would not likely stand the test of future developments. What he expected would survive were the rules that apply mainly to human nature and human conduct, copybook maxims such as, "If you speculate, you will most probably lose your money in the end." Rely on the time-tested principle of insurance with wide diversification of risk. While the name Benjamin Graham is intimately connected, indeed almost synonymous with value investing and the search for undervalued securities, his classic book, in fact, gives far more attention to the down-to-earth basics of portfolio policy. The straightforward, uncomplicated principles of diversification and rational long-term expectations, two of the overarching themes of the little book you are now reading, then to solving the sphinx-like riddle of selecting superior stocks through careful security analysis. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. It is fair to say that, by Graham's demanding standards, the overwhelming majority of today's mutual funds, largely because of their high costs and speculative behavior, have failed to live up to their promise. As a result, a new type of fund, the index fund, is now gradually moving toward ascendancy. Why? Both because of what it does, providing the broadest possible diversification, and because of what it doesn't do, neither assessing high costs nor engaging in high turnover. These paraphrases of Graham's copybook maxims are an important part of his legacy to that vast majority of shareholders whom he believed should follow the principles he outlined for the defensive investor. What's more, Graham was well aware that the superior rewards he had reaped using his valuation principles would be difficult to achieve in the future. In his 1976 interview, he made this remarkable concession: "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities. This was a rewarding activity, say, 40 years ago. But the situation has changed a great deal since then. In the old days, any well-trained security analyst could do a good professional job of selecting undervalued issues through detailed studies. But in the light of the enormous amount of research now being carried on, I doubt whether in most cases such extensive efforts will generate sufficiently superior selections to justify their cost. To that very limited extent, I'm on the side of the efficient market school of thought, now generally accepted by the professors. It is Benjamin Graham's common sense, clear thinking, simplicity, and sense of financial history, along with his willingness to hold fast to the sound principles of long-term investing, even as he was willing to change with the times with respect to the types of securities employed, few of which were more dramatic than the development of the index fund, that constitute his lasting legacy. He sums up his advice. Fortunately for the typical investor, it is by no means necessary for his success that he bring the time-honored qualities of courage, knowledge, judgment, and experience to bear upon his program, provided he limits his ambition to his capacity and confines his activities within the safe and narrow path of standard defensive investment. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. When it's so easy, in fact unbelievably simple, to capture the stock market's returns through an index fund, you don't need to take the extra risks and wasteful costs involved in striving for superior results. With Benjamin Graham's long perspective, hard realism, clear thinking, and wise intellect, there's no doubt whatsoever in my mind that he would have applauded the index fund. Don't take my word for it. While Benjamin Graham's unequivocal written commentary can be easily read as an endorsement of a low-cost all-stock market index fund, don't take my word for it. Listen instead to Warren Buffett, his collaborator, whose counsel and practical aid Graham acknowledged as invaluable in the final edition of The Intelligent Investor. In 1993, Buffett, Graham's protege and collaborator, unequivocally endorsed the index fund. In 2006, he not only reaffirmed this endorsement, but assured me that, decades earlier, Graham had in fact endorsed the index funds. Here, Mr. Buffett: a low-cost index fund is the most sensible equity investment for the great majority of investors. My mentor, Ben Graham, took this position many years ago, and everything I have seen since convinces me of its truth. I can only add, after Forrest Gump, and that's all I have to say about that. Chapter 17. The Relentless Rules of Humble Arithmetic. Reprise. If the message in this book comes across as confident, please remember that my confidence in the index fund is buttressed by the conclusions of many of the smartest, most experienced, most successful investors in America, including Warren Buffett, Charlie Munger, and Benjamin Graham, along with top academics and endowment managers, Nobel laureates Paul Samuelson, William Sharpe, and Daniel Kahneman, and Princeton's Burton Malkiel, Yale's David Swenson, Harvard's Jack Meyer, and MIT's Andrew Lo. To these independent experts add fund industry insiders like Magellan's Peter Lynch, former Investment Company Institute Chairman John Fossil, Philadelphia money manager Ted Aronson, fund supermarket king Charles Schwab, and analyst Mark Holbert. Then heed the similar advice of financial journalists, from Tyler Matheson and Jason Zweig of Money Magazine, to The Economist of London and Jonathan Clements and Holman Jenkins Jr. of the Wall Street Journal. Perhaps even more important, don't forget the convictions of intelligent investors, hundreds of corporate and government pension funds, and millions of individuals, from the very wealthy to the man on the street, who have put their money where their mouth is, investing some $5 trillion in index strategies. That confidence is further buttressed by simply looking at the record, as you've seen in chapter after chapter. That record confirms the superiority of indexing by a wide margin over the average stock fund and the average bond fund as well, and by an even wider margin over the average fund investor. Further, the superiority of the index fund is based not on the fleeting accomplishments of a tiny handful of funds, often achieved by money managers who ceased managing the fund's portfolios years earlier, but on the permanent accomplishments of an all-market strategy where no money manager even enters the picture. Truly, the classic index fund is the only mutual fund you can hold forever. As the great economist John Maynard Keynes warned earlier in a different context, historical returns are of no value unless we can explain the source of those returns. In this context, let me reiterate. The two basic sources of the superior returns achieved by the index fund are 1. The broadest possible diversification, eliminating individual stock risk, style risk, and manager risk, with only market risk remaining. And 2. The tiniest possible costs and minimal taxes. Together, they enable the index fund to provide the gross return earned in the stock market minus a scintilla of cost. Regular equity mutual funds as a group also provide, as they must, a gross return equal to the average return of the market. Today, holding almost 30% of all U.S. stocks, they trade largely with one another, enriching on balance only the brokers who receive the commissions on their vigorous trading of portfolio securities, and who also happen to sell their shares, and the management companies that control them, and as a result, impoverishing, as it were, the net returns the funds deliver to their investors. Fund investment managers, distributors, marketers, administrators, brokers, and investment bankers have garnered staggering rewards. But the high prices they charge for their services, the transaction costs on their high turnover policies, and the excessive taxes that their investors incur have siphoned off an enormous portion of the high real returns provided by the stock market in the past. With the modest real returns on stocks that seem almost destined to prevail in the future, discussed in Chapter 7, those same huge rewards to those in the fund business will confiscate an even larger share, indeed, the lion's share, of the stock market's return. It is as certain as the rising and setting of the sun that in the years ahead, the large cost advantage that exists for the index fund will continue. Price competition among index funds will keep the expense ratios of the low-cost providers at a minuscule level. On the other hand, marketing competition among the giant financial conglomerates that now hold dominion over the fund industry, the drive for profits to the owners of mutual fund management companies, and demands by brokers for extra payments to compensate them for their marketing efforts, will create strong pressure to maintain the high fee revenues generated by their actively managed funds, where, tragically, investors too often ignore the baneful impact of the fees that they pay. Yes, it is at least theoretically possible that the fund industry will at last turn from its present competition to raise prices and serve the interest of fund sellers to a new competition to cut prices and serve the interest of fund buyers. But it's impossible to imagine that the huge gap between the all-in costs of the index fund and the all-in costs of the average equity fund, a gap that is now nearly 2.5 percentage points per year, will be significantly reduced. And even if the gap were slashed by 1/2 to 1.25 percentage points, which will only happen, to use a wonderful barnyard metaphor for the inconceivable, when pigs finally whistle, the classic index fund would remain the investment of choice. There's no similar guarantee that fund investors will continue to suffer the additional loss of return that they have incurred in the past through the twin penalties of market timing and fund selection, an additional gap of some 3 percentage points per year. However, if investors finally realize the error of their ways and remove the negative impact of their counterproductive emotions from the equation, that awesome loss could be substantially reduced in the years ahead. At some point, after all, smart investors ought to figure out for themselves that pouring money into hot funds in hot markets and pulling money out of those funds when they turn cool, often in cold markets, is a loser's game. Further, if fund managers finally lay off the creation and promotion of the fund of the moment, That gap between the return earned by fund investors and the returns reported by the funds themselves could shrink in the years ahead. On the other hand, with the craze in trading ETFs, including those actively managed ETFs that modestly describe themselves as the new paradigm, the gap could get even larger. Whatever the case, it seems set in stone that a substantial gap will continue to exist. As noted in Chapter 5, for example, among the 200 equity funds with the largest cash inflows from 1996 to 2000, only two, a minuscule 1%, enjoyed investor dollar-weighted returns that exceeded the fund's reported per-share time-weighted return. During the past decade on average, investors in these funds earned a return of just 2.4% per year, a shortfall of 6.4 percentage points to the 8.8% return reported by the funds they own, an enormous gap of 73% in annual return. Interestingly, the two funds eking out positive margins, only a minuscule 0.05 and 0.5 percentage points, were terrible performers, and thus largely immune to the enthusiasm of performance chasing by investors. If you expect a substantial reversal of that trend, I would simply warn, don't count on it. But above all, I'm confident about the long-term success that lies in store both for sound investment in business and for the classic index fund and those who invest in it, because virtually the entire case that I present is based on the relentless rules of humble arithmetic. Lest we forget, let me again take you through these rules. 1. Over the long term, stock market returns are created by real investment returns earned by real businesses. The annual dividend yield on publicly held U.S. corporations, plus their subsequent rate of earnings growth. 2. Over the short run, illusory speculative returns, born of the impact of the change in the amount investors are willing to pay for each dollar of corporate earnings, can increase or decrease investment returns. But in the long run, their effect washes out. QED number 1. In investing, the winning strategy for reaping the rewards of capitalism depends on owning businesses, not trading stocks. 3. Individual businesses have come and gone in the past. Given the rapid pace of technological change we face today, along with the powerful new competition provided by globalization, the failure rate of individual corporations is hardly likely to falter. 4. The best protection for individual investors from the risks inherent in individual stocks is diversification. QED number 2. Owning all U.S. businesses through an all-market index fund is the consummate risk reduction strategy. Broad economic risks to corporate earnings and dividends, however, cannot be diversified away. 5. As a group, all investors in the stock market earn its gross returns. When the market provides an 8% return, investors divide up 8% before taking account of costs. What else is new? 6. While investors earn the market's entire return, they do not capture the market's entire return. Rather, they capture the market's return only after the costs of financial intermediation are deducted: commissions, management fees, marketing costs, sales loads, administrative expenses, legal expenses, and custodial fees, etc. Unnecessary taxes simply make the gap larger. QED number 3. Gross market return minus costs equals net return for investors as a group. Remember the Gottrocks family. 7. While all investors as a group must earn the market's net return, mutual fund investors, betrayed by their emotions and by the fund industry into serious error in market timing and fund selection, have done much worse. While it is possible that gap may shrink, it is virtually inconceivable that it will be eliminated. QED number 4. Gross market return minus costs minus timing and selection penalties equals the net return earned by mutual fund investors as a group. Let me remind you again of the 4 E's described in Chapter 5. The two greatest enemies of the equity fund investor are expenses and emotions. In that context, The index fund is the investment of choice, importantly because all of the other choices have serious problems. These problems begin, of course, with the grossly excessive costs that overwhelm the ability of all but the ablest or luckiest fund managers to outpace the index fund. But they don't end there, for the mutual fund industry has created for itself other problems that are wholly counterproductive to the interests of the investors that it seeks to serve. These problems include the industry's very structure, in which managers control the funds that they serve under contract. Mutual funds themselves are required under the law to be governed by boards of directors with a majority of independent members, unaffiliated with the management company. While common sense would suggest that the owners of the fund should be in the driver's seat of fund operations, they are consigned to the rumble seat, essentially powerless and voiceless. The overriding drive among fund managers for asset size, seemingly above all else, simply because assets piled on assets results in fees piled on fees. Yet the record is clear that when small and mid-sized funds capitalize on their flexibility and succeed in generating exceptional returns, they draw immense cash flows and become giant-sized funds that are muscle-bound and inflexible, bound to a return that parallels the stock market, before costs, pinned to the earth, as it were, like Gulliver. The worship of the great god market share not only demands the preeminence of aggressive and costly marketing, promotional and advertising efforts to build existing funds, easiest to do with those that have provided superior returns in the past, but to bring out new funds with each change in the market environment. And so we had go-go funds in the 1960s, Favorite 50 proven growth stocks funds in the 1970s, Government Plus funds in the 1980s, and of course, new economy funds, notably in technology, telecommunications, or internet stocks, in the late 1990s. Today, the popular favorites include real estate funds, emerging market funds, and commodity funds. And we've added a whole new fill-up, the ability to trade these funds all day long in real time via the increasingly popular ETFs. No business can forever ignore the interest of its clients. The fund industry was able to do so during the 1980s and 1990s only because it was blessed with the powerful tailwind of financial markets that provided the highest returns in all history, 18% from stocks, 80% above the long-term average of 10%, 10% from bonds, 100% above the long-term average of 5%. But while investors seem willing to accept the loss of a few percentage points from those enormous returns, if they were even aware of the impact of those all-in costs, they surely will not do so in the environment of sharply lower returns on stocks and bonds alike that seem certain in the years ahead. And as investors come to rely on a measurement benchmark based not on nominal returns, but on real returns, they will be even more skeptical about the ability of the fund industry to serve their interests. The fund industry finally will be hoist on its own petard, an explosion created by the lethal mix of a flawed governance structure with a failed industry mission, the unremitting aim to build enormous assets through opportunistic marketing, and new product adventurism, all lumped on top of costs which cannot possibly be recouped by superior performance. After all, in a brutish world peopled by smart, educated, experienced, and professional money managers who are competing with one another, managers as a group are inevitably consigned to averageness before costs, and after costs are deducted, destined to be losers. Remember, O stranger, that arithmetic is the first of the sciences. The mutual fund industry has forgotten that simple rule. Unless it changes, the industry will begin a long decline, condemned to its fate by its willingness, even its eagerness, to ignore the relentless rules of humble arithmetic. The passively managed index fund is destined to become an even more formidable competitor to its actively managed rivals. Don't take my word for it. Listen first to David Swenson, Chief Investment Officer at Yale University. Invest in low-turnover, passively managed index funds, and stay away from profit-driven investment management organizations. The mutual fund industry is a colossal failure, resulting from its systematic exploitation of individual investors, as funds extract enormous sums from investors in exchange for providing a shocking disservice. Excessive management fees take their toll, and manager profits dominate fiduciary responsibility. Then listen to Holman Jenkins Jr. of the Wall Street Journal. Will customers keep supporting the enormous overhead required to sustain ineffectual, unproductive stock picking across an array of thousands of individual funds devoted to every investing style and economic sector or regional subgroup that some marketing idiot can dream up? Not likely. A brutal shakeout is coming, and one of its revelations will be that stock picking is a grossly overrated piece of the puzzle, that cost control is what distinguishes a competitive firm from an uncompetitive one. And finally, listen to Nobel laureate in economics, Princeton professor Daniel Kahneman. His life's work explains that investors are prone to overconfidence, and how that overconfidence causes us to misinterpret information and let our emotions warp our judgment. When it comes to investing, I don't try to be clever at all. The idea that I could see what no one else can is an illusion. So he sticks with, yes, index funds. But for simple pros, hear this unmistakable endorsement from Warren Buffett. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. Those index funds that are very low cost are investor-friendly by definition, and are the best selection for most of those who wish to own equities. Chapter 18. What should I do now? Funny money, serious money, and investment strategy. Deep down, I remain absolutely confident that the vast majority of American families will be well served by owning their equity holdings in an all-U.S. stock market index portfolio, and holding their bonds in an all-U.S. bond market index portfolio. Investors in high tax brackets, however, would hold a very low-cost quasi-index portfolio of high-grade intermediate-term municipal bonds. While such an index-driven strategy may not be the best investment strategy ever devised, the number of investment strategies that are worse is infinite. The rationale for a 100% index fund portfolio remains solid as a rock. But I also fear, and again deep down, that very few investors will follow that approach, the very essence of simplicity, for their entire investment portfolio. You must now be as exhausted as I am by the unremitting pounding of the theme that simplicity is the answer and that complexity simply doesn't work. But we investors seem all too willing to ignore the verities described in this book. Instead of index funds, we opt for costly active funds and trade them to excess. Why? We are sold funds more often than we buy them. We have far too much self-confidence. We crave excitement. We succumb to the distraction that is the stock market. We fail to understand the arithmetic of investing and the arithmetic of mutual funds. I have no ability to tell you whether betting on managers who pursue active investment strategies will win or lose in the future, but I can guarantee you that it hasn't worked very well in the past. To be sure, there are lots of smart, engaging, purposeful money managers and financial advisors. And all that activity that seems endemic to the investment business will be exciting and enticing. But after all is said and done, you'll find that there are no surefire solutions for investment success, wealth without risk, if you will. It's just not a realistic expectation. Nonetheless, building an investment portfolio can be exciting, and trying out modern remedies for age-old problems lets you exercise your animal spirits. If you crave excitement, I would encourage you to do exactly that. Life is short. If you want to enjoy the fun, enjoy. But whatever you do, maintain the index fund as the core of your program. That core should represent at least 50% of your invested assets. In fact, my recommendation is that the core represent at least 95% of your assets. Consider that your serious money account. What about your funny money account? I would put not 1 penny more than 5% of your investment assets into the funny money account. Enjoy the fun of gambling and the thrill of the chase, but not with your rent money, and certainly not with college education funds for your children, nor with your retirement nest egg. Yes, test, if you will, 2 or 3 aggressive investment strategies. You're likely to learn some valuable lessons, and it probably won't hurt you too much in the short term. Here are some funny money approaches and my advice about using them. 1. Individual stocks? Yes. Pick a few. Listen to the promoters. Listen to your broker or advisor. Listen to your neighbors. Heck, even listen to your brother-in-law. 2. Actively manage mutual funds? Yes, but only if they are run by managers who own their own firms, who follow distinctive philosophies, and who invest for the long term without benchmark hugging. Don't be surprised if the managed fund loses to the index fund 1 year of every 3. 3. Closet index funds whose returns are tied closely to the returns of the stock market and which carry excessive costs? No. 4. ETFs? Those that track defined industry sectors that exclude the field in which the family breadwinner earns his or her living? Maybe. Those that hold the classic index portfolio? Yes. But in the serious money account. But whatever the case, don't speculate in ETFs. Invest in them. 5. Commodity funds? No. Of course, there will be commodity bubbles, which will attract you only after they have inflated to absurd proportions. But unlike stocks and bonds, commodities have no fundamentals to support them, that is, neither earnings and dividends nor interest payments. 6. Hedge funds? No. Too much hype, too much diffusion of performance among winners and losers, too many different strategies, too many successful managers who won't accept your money, too much tax inefficiency, and surprise, management fees that are so high as to destroy even the small chance you have of winning. Hedge funds, it is said, are not an investment strategy, but a compensation strategy. 7. Hedge funds of funds? No. Really no. If a hedge fund is too expensive, just imagine a fund of funds that lays on a whole other layer of expenses. If you decide to have a funny money account, be sure to measure your returns after 1 year, after 5 years, and after 10 years. Then, compare those returns with the returns you've earned in your serious money account. I'm betting that your serious money will win in a landslide. If it does, you can then decide whether all that fun was adequate compensation for the potential wealth you've relinquished. Fun, finally, may be a fair enough purpose for your funny money account. But how, you ask, should you invest your serious money account? That 50% to 95% of your assets on which you now depend or will one day depend for your comforts of human existence. Use an index fund strategy. Even better, use it for 100% of your assets. The fact that few of you are likely to go that far doesn't mean it isn't the best strategy. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results, after fees and expenses, delivered by the great majority of investment professionals. If Warren Buffett says it, as he did, it's surely worth listening to. Indexing is also, for most investors, the best way to own bonds. I favor the pristine and classic all-U.S. stock market and all-bond market approach. But there are perfectly reasonable alternative strategies for supplementing the index funds in your serious money portfolio. Kept within limits, here are some acceptable variations. Given the limitations of my space and your attention span, I'll deal with each in a cursory manner here. But further study on your part will be rewarded. An international flavor. While international businesses comprise about 25% of the revenues and profits of U.S. corporations, many investors seek a larger global participation. Although foreign stocks account for about 1/2 of the world's market capitalization, I recommend that they account for no more than about 20% of your own equity portfolio. By far the soundest way to acquire that participation is to hold, no surprise here, a low-cost total international index fund that tracks the returns of all non-U.S. corporations. A modest holding in a low-cost emerging market index fund is also a reasonable approach. Slice and dice. Impressed by both the long-term performance and recent performance of value stocks and small-cap stocks, some investors hold the all-market or S&P 500 index fund as the core and add a value index fund and a small-cap index fund as satellites. I'm skeptical that any kind of superior performance will endure forever. Nothing does. But if you disagree, it would not be unreasonable to hold, say, 85% in the core, another 10% in value, and another 5% in small cap. But don't push too far in increasing the risk that your return will fall short of the market's return. Bond strategy. The all-U.S. bond market portfolio remains the bond investment of choice. It holds investment-grade corporate bonds, mortgage-backed securities, and U.S. Treasuries, and has an intermediate term maturity in the range of 5 to 10 years. Yet we all differ in our liquidity preferences, income requirements, and tolerance for volatility. Combining a mix of index funds linked to short-term, intermediate-term, and long-term bonds in varying amounts is a sound way of honoring these preferences. I don't recommend money market funds in this mix. They are for savings, not for investment, but rather favor the use of short-term bond funds for investors who lean toward greater short-term stability of principal and, in return, are willing to accept less durability of income over the long term. Inflation protection. Bond investors should carefully consider the use of inflation-linked bonds in their accounts. The U.S. Treasury offers these bonds in various maturities, each of which pays a basic interest rate, currently about 2.4% on the 10-year Treasury note, plus the current rate of inflation, about 2.4%. This all-in yield totals 4.8%, the same as the regular 10-year Treasury. The difference is that if inflation rises, or for that matter, falls, the total return that you earn will reflect the change. Since the Treasury note is deemed risk-free, there is no need for the diversification of an index fund. If you prefer a bond fund owning inflation-linked bonds, choose only the very lowest-cost funds. In effect, an index strategy. Asset allocation. How much in stocks? How much in bonds? Asset allocation is almost universally considered the most important determinant of the long-term investment return you will earn. Most of us will want more stocks when we're young, have relatively small assets at stake, many years to recoup losses, and do not depend upon investment income. When we're older, we're likely to prefer more bonds, for if we've planned intelligently and invested wisely, our asset accumulations have grown to substantial size. We have far less time on our side. And, when retired, we will rely on our portfolios to produce a steady and continuing stream of income. My favorite rule of thumb is roughly to hold a bond position equal to your age. 20% when you are 20, 70% when you're 70, etc. There are no hard and fast rules here. Most experts think my guidelines are too conservative, but I am conservative. Balanced index funds. Since the formation of the first balanced index fund in 1990, 60% total U.S. stock market, 40% total U.S. bond market, a whole variety of variations on that theme have been created. First came life strategy funds, each with a fixed allocation ranging from roughly 20% to 80% in stocks, often with a moderate international allocation, and the remainder in U.S. bonds. More recently, target funds have come to the fore. Here, investors can begin with an allocation appropriate to their age, which inches gradually toward a more conservative allocation as they approach the retirement age they have targeted. Such gradual rebalancing makes considerable sense. Essentially, your allocation strategy is on automatic pilot for your lifetime. The most effective way to implement the strategy is through stock and bond index funds. Such a strategy is likely to be carefree, even boring, even as it is likely to be enormously productive. The role of low-cost index funds in asset allocation strategies cannot possibly be underestimated. With the current slender 2% spread, what we call the equity premium, between the prospective stock return, about 7% per year, and prospective returns on the U.S. one-year Treasury bond, about 5% in the coming decade, you can eat your cake and have it too, for index funds can deliver virtually that entire premium to investors. On the other hand, even costs as low as 2% per year for an actively managed equity fund would erase the entire premium. Result? Under these circumstances, a fund investor with 75% stocks in an active equity fund and 25% in bonds would earn a net annual return of 5% per year. On the other hand, an investor in a passive equity fund pursuing a far more conservative 50-50 strategy would earn 6%. 20% more return with 33% less risk would seem to be an offer that's too good to refuse. As you seek investment success, realize that it's never given to us to know what the returns stocks and bonds will deliver in the years ahead, nor the future returns that might be achieved by alternatives to the index portfolio. But take heart. For all the inevitable uncertainty amidst the eternally dense fog surrounding the world of investing, there remains much that we do know. We know that we must start to invest at the earliest possible moment and continue to put money away regularly from then on. We know that yes, investing entails risk, but we also know that not investing dooms us to financial failure. We know the sources of returns in the stock and bond markets, and that's the beginning of wisdom. We know that the risk of selecting specific securities, as well as the risk of selecting both managers and the risk of selecting investment styles, can be eliminated by the total diversification offered by the classic index fund. Only market risk remains. We know that costs matter overpoweringly in the long run, and we know that we must minimize them. We also know that taxes matter and that they too can be minimized. We know that neither beating the market nor successful market timing can be generalized without self-contradiction. What may work for the few cannot work for the many. We know that alternative asset classes such as hedge funds aren't really alternative, but simply pools of capital that invest or overinvest or disinvest in the very stocks and bonds that comprise the portfolio of the typical investor. Finally, we know what we don't know. We can never be certain how our world will look tomorrow, and we know even less about how it will look a decade hence. But with intelligent asset allocation and sensible investment selections, you'll be prepared for the inevitable bumps along the road and should be able to glide right over them. Our task remains, earning our fair share of whatever returns that our business enterprises are generous enough to provide in the years to come. That, to me, is the ultimate definition of investment success. The classic index fund is the only way to guarantee that you will achieve that goal. If you follow the simple guidelines presented in this chapter and then stay the course, you too can be a winner. Don't take my word for it. The ideas in this closing chapter seem like common sense to me, and perhaps they seem like common sense to you as well. But if you have any doubt, listen to them echo in these words by Clifford S. Asness, Managing Principal of AQR Capital Management. We basically know how to invest. A good analogy is to dieting and diet books. We all know how to lose weight and get in better shape, eat less, and exercise more. That is simple, but it is not easy. Investing is no different. Some simple but not easy advice for good investing and financial planning in general includes: diversify widely, keep costs low, rebalance in a disciplined fashion, spend less, save more, make less heroic assumptions about future returns. When something sounds like a free lunch, assume it is not free unless very convincing arguments are made, and then check again. Stop watching the stock markets as if they were on ESPN and work less on investing, not more. Perhaps the most important advice in true Hippocratic fashion is, do no harm. You do not need a magic bullet. Little can change the fact that current expected returns on a broad set of asset classes are low versus history, and levering up low expected returns to make them high is not usually a great idea. Stick to the basics with discipline. Staying the course. Earn $25,000 a year. Invest for 30 years. Accumulate $1,391,407. The simple ideas in this closing chapter really work. Listen to these words from a letter I received a few years ago from a Vanguard shareholder, holding our 500 index fund and total stock market index fund, several of our managed equity funds and taxable and tax-exempt bond funds, and a diversified list of individual stocks. Most of my shares were purchased when you were chairman. I am 85 years old and have never earned more than $25,000 a year. I started investing in 1974 with $500. I have only bought, never sold. I remember when things were not going well, your advice was, stay the course. He enclosed a list of his investments at the start of 2004. Total value, $1,391,407. Of course, as a dyed-in-the-wool indexer, I believe the classic index fund must be the core of that winning strategy. But even I would never have had the temerity to say what Dr. Paul Samuelson of MIT said in a speech to the Boston Society of Security Analysts in the autumn of 2005. The creation of the first index fund by John Bogle was the equivalent of the invention of the wheel and the alphabet. Both these essentials of our existence that we take for granted every day have stood the test of time. I am certain that the index fund will do exactly that. We hope you've enjoyed this audio renaissance production of The Little Book of Common Sense Investing. This program was produced and directed by Lisa Bainey. Executive producer, Laura Wilson. Text copyright 2007 by John C. Bogle. Production copyright 2007 by Audio Renaissance, a division of Holtzbrink Publishers, LLC. All rights reserved. For the stock market. The first shall be last. Sadly, the orientation of fund investors toward recent short-term returns works worst in strong bull markets. Consider the example of the top 10 performers among the 851 equity funds in operation during the great new economy market bubble of 1997 to 1999. A wondrous group they were. Focused on internet, telecom, and technology stocks, these funds generated an average return of 55% per year during the upswing, a cumulative return of 279% for the full 3 years. Remarkable. Well, you can guess what came next. The bubble burst, and one by one, just as the good book warned, the first shall be last. Really? Over the next 3 years, 2000 to 2002 inclusive, every one of the original top 10 funds plummeted into the bottom 60, with not a single fund in the original top 10 ranked higher than number 790. Fund number 9 on the upside actually was last, number 851 on the downside. Fund number 1 dropped in rank to number 841. Fund number 2 dropped to number 832, and fund number 3 tumbled to number 845. On average, the one-time 10 top funds in the bull market were outperformed by 95% of their peers in the bear market that followed. For investors who believed that the past would be prologue, it was not a pretty result. Please remember that even a single annual gain of 55%, followed by a loss of 34%, doesn't leave the investor with a 21% gain. More like 2%. Do the arithmetic. And with 3 years of average annual gains of 55% on the upside and annual losses averaging 34% on the downside, it was much worse. These aggressive new economy funds ended up with a cumulative positive return averaging 13% for the full 6-year period, a far cry from the S&P 500's cumulative gain of 30%. Yet while that return was not particularly satisfactory in terms of the traditional returns reported by the average equity fund, it was hardly a disaster. But for the shareholders of the funds, it was a disaster. By investing after seeing those mouth-watering cumulative returns that had averaged almost 280%, achieved in a soaring bull market, nearly all of the buyers of these funds had missed the upside. Then, not a moment too soon, they caught the full force of the downside. Their funds tumbled by an astonishing average of 70% during the next 3 years. Result, while a net gain of 13% was achieved by the funds themselves, the investors in these funds incurred a loss of 57%. By investing in these once high-flying funds, more than half of the capital investors had placed in these hot funds had gone up in smoke. The message is clear. Avoid performance chasing based on short-term returns, especially during great bull markets. Though the results are hardly as dramatic, the principle of don't chase past performance also holds during more sedate stock markets. In my first book, Bogle on Mutual Funds, 1993, I compared the records of the 20 top-performing mutual funds during each year from 1982 through 1992, with their records in the subsequent year. As it happened, the funds that ranked number 1 in each year averaged a subsequent average ranking of 284 among the list of 681 funds, outpacing 58% of their peers, or barely above average. The highest achievement on the 20-fund list for that period was turned in by the number 1 funds, averaging a rank of 100 in the subsequent years. The clear reversion to the mean suggested by that single test represented powerful evidence that winning performance by a mutual fund is unlikely to be repeated. But of course, there is no reason, except common sense, to assume that the 1982 to 1992 experience would recur. So, just for fun, I repeated the test in 2006, beginning with the top-performing 20 funds in 1995 and the top 20 funds in each of the 9 subsequent years. I then checked the rank of each fund in the following year, just as before. In general, the results were remarkably similar. The average subsequent rank of the top 20 funds in 1995 to 2005 was 619, outpacing 57% of their peers and barely above the average fund among the 1,440 fund total, just like the prior test. In an interesting reversal of fortune, however, the number 1 funds of that era turned out to have not the highest subsequent ranking, but the lowest ranking among the top 20 list. These champions subsequently earned an average ranking of 949 among the 1,440 fund total, outpacing only 34% of their peers. While the first can be first sometimes, the first can be last at other times. A wonderful illustration of the inevitable randomness of fund performance. The message is clear. Reversion to the mean, RTM. In this case, the tendency of funds whose records substantially exceed industry norms to return to average or below is alive and well in the mutual fund industry. As we have seen in stock market blow-offs, the first shall be last. But in more typical environments, reversion to the fund mean, which, as we have seen in earlier chapters, substantially lags the return earned by a stock market index fund, is the rule. So just remember that the stars produced in the mutual fund field are rarely stars. All too often they are comets, lighting up the firmament for a few moments in time and then flaming out, their ashes floating gently to earth. With each passing year, the reality is increasingly clear. Fund returns seem to be random. Yes, there are rare cases where skill seems to be involved, but it would require decades to determine how much of a fund's success can be attributed to luck and how much attributed to skill. And by then, you might ask yourself questions like these. 1. How long will that manager, with that staff, and with that strategy remain on the job? 2. If the fund's assets are many times larger at the end of the period than at the beginning, will the same results that were attractive in the first place be sustained? In short, selecting mutual funds on the basis of short-term performance is all too likely to be hazardous duty and almost always destined to produce returns that fall far short of those achieved by the stock market itself, so easily achievable through an index fund. Don't take my word for it. Listen to Nassim Nicholas Taleb, author of Fooled by Randomness. Toss a coin, heads, and the manager will make $10,000 over the year. Tails, and he will lose $10,000. We run the contest for the first year for 10,000 managers. At the end of the year, we expect 5,000 managers to be up $10,000 each, and 5,000 to be down $10,000. Now we run the game a second year. Again, we can expect 2,500 managers to be up 2 years in a row. Another year, 1,250. A fourth one, 625. A fifth, 313. We have now, simply in a fair game, 313 managers who made money for 5 years in a row. And in 10 years, just 10 of the original 10,000 managers. Out of pure luck. A population entirely composed of bad managers will produce a small amount of great track records. The number of managers with great track records in a given market depends far more on the number of people who started in the investment business in place of going to dental school, rather than on their ability to produce profits. That may sound theoretical, so let's get down to brass tacks. Hear Money Magazine's colloquy with Ted Aronson, partner of successful money management firm Aronson Johnson Ortiz. Question. You've said that investing in an actively managed fund, as opposed to a passively run index fund, is an act of faith. What do you mean? Answer. Under normal circumstances, it takes between 20 and 800 years of monitoring performance to statistically prove that a money manager is skillful, not lucky. To be 95% certain that a manager is not just lucky, it can easily take nearly a millennium, which is a lot more than most people have in mind when they say long term. Even to be only 75% sure he's skillful, you generally have to track a manager's performance for between 16 and 115 years. Investors need to know how the money management business really works. It's a stacked deck. The game is unfair. Question. Where do you invest? Answer. In Vanguard index funds. I've owned Vanguard Index 500 for 23 years. Once you throw in taxes, it just skewers the argument for active management. Personally, I think indexing wins hands down. After tax, active management just can't win. Finally, Money Magazine columnist and author Jason Zweig sums up performance chasing in a single pungent sentence. Buying funds based purely on their past performance is one of the stupidest things an investor can do. Chapter 10. Seeking help in selecting funds? Look before you leap. As we now know from the evidence presented in the 2 previous chapters, selecting winning equity funds over the long term bears all the potential success of looking for a needle in the haystack, and selecting winning funds based on their performance over relatively short-term periods in the past is all too likely to lead, if not to disaster, at least to disappointment. So why not abandon these do-it-yourself approaches and rely on professional advice? Pick a financial consultant, the designation usually used by the stockbrokers of Wall Street and indeed brokers everywhere, or an investment advisor, the designation usually applied to non-brokers who usually, but not always, work on a fee-only rather than commission basis. I'll attempt to answer that question in this chapter, but before I do, I want to note that I'm focusing only on the ability of advisors to help you select equity funds that can produce superior returns for your portfolio. Professional investment advisors provide many other services, including asset allocation, information on tax considerations, advice on saving while you work, and on spending when you retire, and they are always there to consult with you about the financial markets. Advisors can encourage you to prepare for the future and are in a position to help you deal with the many extra investment decisions that have investment implications. That is, when you need to raise cash for a purchase of a home, building a fund for your children's college education, etc. Experienced advisors may also help you to avoid the potholes along the investment highway. Put more grossly, they may help you avoid making such dumb mistakes as chasing past performance or trying to time the market. At their best, these are important services that can enhance the implementation of your investment program. The overwhelming majority of investors rely on brokers or advisors for help in penetrating the dense fog of complexity that, for better or worse, permeates our financial system. If the generally accepted estimate that some 70% of America's 55 million families who invest in mutual funds do so through intermediaries is correct, then only about 15 million families choose the do-it-yourself road. The remaining 40 million families rely on professional helpers. That's the strategy that the Gottrocks family tried, as described in the parable at the beginning of this book, only to find that it resulted in failure. We'll never know exactly how much value is added or subtracted by these helpers. But it's hard for me to imagine that as a group they are other than, well, average. That is, their advice on equity fund selection produces returns for their clients that are probably not measurably different from those of the average fund as described in Chapter 4, some 2.5 percentage points per year behind the stock market itself, as measured by the S&P 500 index. Of course, I'm willing to consider the possibility that the fund selections recommended by advisors are better than average. As I'll explain in the next chapter, if they merely select funds with the lowest all-in costs, hardly rocket science, they'll do better. If they're savvy enough to realize that high turnover funds are highly tax inefficient, they'll pick up important additional cost savings for you in transaction costs and taxes. If they put those two strategies together and emphasize low-cost index funds, as so many advisors do, so much the better for their clients. And if professional investment consultants are wise enough, or lucky enough, to keep their clients from jumping on the latest and hottest bandwagon, for example, the new economy craze of the late 1990s reflected in the mania for funds investing in technology, telecommunications, and internet stocks, their clients could earn returns that easily surpass the disappointing returns achieved by fund investors as a group. Remember the additional shortfall of 2.7 percentage points per year relative to the average equity fund that we estimated in Chapter 5? During 1980 to 2005, the nominal return of fund investors came to just 7.3% per year, despite a wonderful stock market in which a simple S&P 500 index fund earned a return of 12.3%. Alas, from the standpoint of the advisors, there is simply no evidence that the fund selection advice they provide has produced any better returns than those achieved by fund investors on average. In fact, the evidence goes the other way. A recent study by a research team led by 2 Harvard Business School professors concluded that, during 1996 to 2002 alone, the underperformance of broker channel funds, advisors sold, relative to funds sold through the direct channel, purchased directly by investors, cost investors approximately $9 billion per year. Specifically, the study found that advisor asset allocations were no better, that they chased market trends, and that those they advised paid higher upfront charges. In all, the study concludes that the weighted average return of equity funds held by investors who relied on advisors, excluding all charges paid up front or at the time of redemption, averaged just 2.9% per year. 2.9% per year, compared with the 6.6% earned by investors who take charge of their own affairs. This powerful evidence, however, does not bring the researchers to the clear conclusion that advice in its totality has negative value. We remain, the report states, open to the possibility that substantial intangible benefits exist, and will undertake more research to identify these intangible benefits and explore the elite group of advisors who do improve the welfare of households who trust them. There is other powerful evidence that the use of stockbrokers, as distinct from financial advisors, has a strong negative impact on the returns earned by fund investors. In a study prepared for Fidelity Investments covering the 10-year period 1994 to 2003 inclusive, broker-managed funds had the lowest ratings, relative to their peers, of any group of funds. The other groups included funds operated by privately owned managers, by publicly owned managers, by managers owned by financial conglomerates, and by bank managers. The Merrill Lynch funds, for example, were 18 percentage points below the fund industry average. The Goldman Sachs and Morgan Stanley funds were 9 percentage points below average. And the Wells Fargo and Smith Barney funds were both 8 percentage points behind. It is the job of the brokerage firm and its brokers and financial consultants to sell something every single day. When the firm introduces a new fund, it must be sold to someone. Imagine a day when nobody sold anything and the stock market lay fallow, silent all day long. A Merrill Lynch example illustrates the challenges faced by investors who rely on stockbrokers. In March of 2000, when the bubble created by the internet stock craze was at its peak, Merrill Lynch, the world's largest stock brokerage firm, jumped on the bandwagon with 2 new funds to sell. Merrill created a pair of new economy funds. One was a Focus 20 fund, based on the then popular theory that if a manager's 100 favorite stocks were good, surely his 20 favorites would be even better. The other was Yes, an Internet Strategies Fund. The public offering of the 2 funds was an incredible success. Merrill's brokers pulled in $2 billion from their trusting, or was it performance-chasing clients, $0.9 billion in Focus 20, and $1.1 billion in Internet Strategies. The subsequent returns of the funds, however, were an incredible failure. Not surprising. The smartest time to sell a new fund to investors, when it's hot, is often the dumbest time to buy it. Internet Strategies went into the tank almost immediately. Its asset value dropped 61% during the remainder of 2000 and another 62% by October 2001. A total loss of a cool 86%, as most of its investors cashed out their shares at huge losses. Then, with the fund's original $1.1 billion of assets down to just $128 million, Merrill decided to kill Internet Strategies and give it a decent burial, merging it with another Merrill fund. Keeping a record like that alive would have been a continuing embarrassment. For what it's worth, the losses in Focus 20 were less severe. Its asset value declined 28% in the remainder of 2000, another 70% in 2001, and another 39% in 2002, before finally posting positive returns in the 3 years that followed. On balance, its cumulative lifetime return through late 2006 came to minus 79%. Investors have regularly withdrawn their capital, and the fund's assets, which would reach almost $1.5 billion in 2000, currently languish at $82 million, a 95% decline. But unlike its Internet Strategies cousin, Focus 20 soldiers on. The lesson remains. The $2 billion marketing successes of the Merrill Lynch Internet Strategies Fund and Focus 20 Fund were utter failures for their clients, who lost some 80% of their hard-earned savings. The New York Times contest, $50,000 invested in 1993. Capital appreciation of mutual fund portfolios of advisors in 2000, $88,500. In an S&P index fund, $138,750. A more extensive test of the ability of financial advisors to outpace the S&P 500 index was initiated by the New York Times in 1993. The editors asked 5 respected advisors, none were brokers, how they would invest $50,000 for a tax-free retirement account, holding mutual fund shares for an investor who had a time horizon of at least 20 years. The comparative standard would be the returns earned by Vanguard 500 Index Fund. Each quarter, the Times faithfully published the records of the index fund and the advisors, tracking their initial portfolios and the subsequent changes they made. By 2000, 7 years later, the Times reported their accomplishments. The $50,000 hypothetical portfolios run by the advisors had grown, on average, to a value of $138,500 on June 30, 2000. The highest value was $155,100, the lowest, $111,800. While the editors properly acknowledged that not one of these advisors was able to outpace the result of the Vanguard 500 Index Fund, they failed to report its final value based on that initial investment of $50,000. The answer, I thoughtfully provided it to the paper in a subsequent letter to the editor, was $188,750. That is, the average advisor produced a paper profit of $88,500 on his portfolio of recommended funds, about 40% less than the profit of $138,750 on the index fund. All the news that's fit to print? In mid-2000, the Times abruptly terminated the contest without notice. I do not know why, since the original stated intention was to make a 20-year evaluation. But I can guess either that the advisors were too embarrassed to continue to participate in the contest, or that, as the differential in favor of the passively managed index fund grew quarter after quarter, the contest became sort of non-newsworthy, even boring. I also have no idea why the New York Times determined that the remarkable differential in favor of the index fund was not news that's fit to print. Of course, we'll never know what would have happened had the contest continued, but the fact is that the Times terminated it at the moment of triumph for the index fund, and at the very peak of the bull market. Since then, the index fund, like the market itself, of course, has barely held its own. While we don't know whether the advisors would have changed their portfolios, we can calculate how those funds they held in 2000 have since performed. 2 advisors did considerably better than the index fund during that subsequent period. One was worse, and one about the same. The results of the 5th advisor can't be measured, for 2 of the funds in his portfolio no longer exist. Despite this all-too-typical reversion to the mean, the index fund continued its superiority for the full period, with a final value of $181,800 compared to $167,700 for the fund portfolio of the average advisor, surpassing on balance 3 of the 4 remaining advisors. So even if we give these advisors the benefit of the doubt in this contest of active fund advisors versus the passive index fund, the index fund wins again. I endorse the idea that for many, indeed most investors, financial advisors may provide valuable service in giving you peace of mind, in helping you establish a sensible fund portfolio that matches your appetite for reward and your tolerance for risk, and in helping you to stay the course in troubled waters. But the evidence I've presented so far strongly confirms my original hypothesis that, vital as those services may be, advisors as a group cannot be credibly relied upon to add value by selecting winning funds for you. Let me add just one final piece of compelling evidence to support that thesis. Mark Holbert, editor of the Holbert Financial Digest, has been monitoring the real-time records of financial advisors who report their recommendations in newsletters subscribed to by investors. He has tracked the performance of these advisors over the past 26 years, and here's what he finds. 1. Most of the several hundred newsletters now being published didn't even exist in 1980. 2. Of the 35 that existed in 1980, only 13 are still in business today. Only 3 outperformed the market over the subsequent 26 years. 3. Of the other 22 advisors, only 2 were ahead of the S&P 500 index when they discontinued publication. 4. An initial $100,000 investment in the S&P 500 index 26 years ago would be worth nearly $2,500,000 today. By way of contrast, a similar investment in the portfolios managed by the advisors tracked by Holbert would be worth about $1,400,000. Holbert's conclusion: you can outperform more than 80% of your fellow investors over the next several decades simply by investing in an index fund and doing nothing else. Deja vu all over again? Perhaps Yogi Berra's famous aphorism is apt here. Consider, if you will, Holbert's finding that only 3 of the 35 original advisory organizations in 1980, 9%, were able to beat the stock market. Then consider the finding in Chapter 8, Don't Look for the Needle, Buy the Haystack, that only 24 of 355 mutual funds in business in 1970, 7%, were able to beat the stock market by 1 percentage point or more per year. Those similar tiny odds in favor of success are sending us the same message. Then consider the return calculated by Holbert on that original $100,000, $2.5 million in the index, compared to just $1.4 million for the portfolio of the average advisor. How similar to the results of the study I prepared for the Vanguard Board of Directors in 1975. My recommendation that we form the world's first index fund was based in part on the fact that $100,000 invested in the average equity fund in 1945 would have grown to $2.5 million in the S&P 500 index versus $1.6 million in the average equity mutual fund. Those similar margins of approximately $1 million in favor of indexing are also sending us the same message. Listen to it. These historic parallels surely reinforce the thesis that index funds endure, while most advisors and funds do not. That index fund returns strongly exceed the returns earned even by those funds and advisors that do survive. That the odds against successful fund selection by advisors are large, and that compounding these rather consistent differentials in rates of annual return mount up to truly staggering differences in wealth accumulation over the long term. If you decide to select an advisor, please consider these findings. Then make sure you are paying a fair fee, which of course results in a deduction from whatever rate of return your fund portfolio earns. Since most investment advisory fees tend to begin in the range of 1% per year, be sure to balance the worth of all the peripheral services that advisors provide against the reduction in your returns that those fees are likely to represent over time. Finally, and this will hardly surprise you, look with particular favor on advisors who recommend stock and bond index funds in their model portfolios. Don't take my word for it. Listen, please, once again to the widely respected investment advisor William Bernstein, who writes in the 4 Pillars of Investment Wisdom as follows: you will want to ensure that your advisor is choosing your investments purely on their investment merit and not on the basis of how the vehicles reward him. The warning signs here are recommendations of load funds, insurance products, limited partnerships, or separate accounts. The best and only way to make sure that you and your advisor are on the same team is to make sure that he is fee only, that is, that he receives no remuneration from any other source besides you. Fee only is not without pitfalls, however. Your advisor's fee should be reasonable. It is simply not worth paying anybody more than 1% to manage your money. Above $1 million, you should be paying no more than 0.75%, and above $5 million, no more than 0.5%. Your advisor should use index or passive stock funds wherever possible. If he tells you that he is able to find managers who can beat the indexes, he is fooling both you and himself. I refer to a commitment to passive indexing as asset class religion. Don't hire anyone without it. Chapter 11. Selecting the lowest cost equity funds. The more the managers take, the less the investors make. What have we learned in the previous 3 chapters? Selecting equity funds based on long-term past performance hasn't been the answer. Selecting funds based on past short-term performance hasn't been the answer either. Even relying on the best-intentioned financial advice seems to work only spasmodically. How can successful fund selection prove so difficult? Because of something that, deep down, we intuitively know. Performance comes and goes. But we also know something else worth knowing. We can be more successful in selecting winning funds by focusing not on the inevitable evanescence of past performance, but by focusing on something that does seem to go on forever, or, more fairly, a factor that usually persists over sustained periods of time. That factor is the costs of owning mutual funds. Costs go on forever. One major cost is the fund's expense ratio, and it tends to change little over time. While some funds scale down their fee rates as assets grow, the reductions are usually sufficiently modest that high-cost funds tend to remain high-cost, that low-cost funds tend to remain low-cost, and the handful of very low-cost funds tends to remain very low-cost, and that average-cost funds, too, tend to persist in that category. Another large cost of equity fund ownership is the sales charge paid on each purchase of shares. It, too, tends to persist. Load funds rarely become no-load funds, and vice versa. I can recall no large fund organization making the immediate conversion from a load to a no-load distribution system since Vanguard took that drastic and unprecedented step more than 30 years ago. Funds' portfolio turnover costs also tend to persist. Transactions cost money, and we estimate that turnover costs are roughly 0.5% on each purchase and sale, meaning that a fund with 100% portfolio turnover would cost shareholders about 1% of assets year after year. Similarly, 50% turnover would cost about 0.5%, and 10% turnover would cost about 0.1%, and so on. Rule of thumb: turnover costs equal 1% of the turnover rate. Most comparisons of fund costs rely solely on reported expense ratios, and uniformly find that such ratios correspond inversely with returns. Higher costs are associated with lower returns, not only for equity funds as a group, but in each of the 9 Morningstar style boxes: large, mid, and small cap funds, growth, value, and blended objectives. While few comparisons take into account the additional cost of fund portfolio turnover, a similar relationship exists. Funds in the low turnover quartile consistently outperform those in the high turnover quartile for all equity funds as a group and in all 9 style boxes. When we add that turnover cost to each fund's expense ratio, the relationship is sheer dynamite. Taking into account both costs, we find that the all-in costs range from 0.9% in the lowest cost quartile to 3% in the highest cost quartile. This exercise ignores sales charges and, therefore, overstates the net returns earned by load funds. Costs matter. That 2.1 percentage point difference constitutes a huge portion of the 2.7-point advantage in the returns among the lowest cost funds over the highest cost funds during the past 10 years. Net annual return of low-cost funds, 11.7%. Net annual return of high-cost funds, just 9%. A 30% enhancement in each year's return achieved simply by relying on relative costs as our guide to performance. Please also note that in each of the fund quartiles, when we add the cost to the fund's reported net returns, the gross annual returns earned in each category are virtually identical. They fall into a narrow range, a high of 12.8% for the third quartile and a low of 12% for the fourth quartile. Costs indeed account for the difference. And there is another significant difference. Step by step, as costs increase, so does risk, using as our measure the volatility of monthly returns. Those lowest expense, lowest turnover cost funds assumed fully 34% less risk than their highest cost cousins. When we take that reduction in risk into account, the risk-adjusted annual return for the low-cost quartile comes to 11.9%, fully 47% higher than the 8.1% risk-adjusted return of the high-cost quartile. When we compound those annual returns over time, the cumulative difference reaches staggering proportions. Total compound gain for the period, 207% for the low-cost funds, 118% for the high-cost funds, an enhancement arising almost entirely from the cost differential. In other words, the final value of the low-cost funds more than tripled over the decade, while the value of the high-cost funds barely doubled. Surely, fishing in the low-cost pond should enhance your returns, and by a wide margin at that. Again, yes, costs matter. But if one is seeking the lowest cost funds, why limit the search to actively managed funds? The classic index fund had the lowest costs of all, an expense ratio averaging 0.2% per year during this period. With no measurable turnover costs, its total all-in costs were but 0.2%. The gross return of the 500 index fund was 11.4% per year, the net return 11.2%. Carrying a lower risk than any of the four cost quartiles, annual price volatility averaging 15.7%, its risk-adjusted annual return was 11.4%, for a cumulative risk-adjusted gain smack in the middle of the top quartile. The index fund's compound profit of 194% surpassed the 154% compound profit earned by the average fund by about one-third, all the more impressive since that average is overstated, as always, by the fact that only the funds that were good enough to survive the decade are included in the data. What's more, selecting the index fund eliminated the need for all that looking for those few needles in the haystack, represented by the very few active funds that have performed better than the market haystack itself, in the often vain hope that their winning ways will continue over decades yet to come. If investors could rely on only a single factor to select future superior performers and to avoid future inferior performers, it would be fund costs. The record could hardly be clearer. The more the managers and brokers take, the less the investors make. So why not own an index fund with no manager and no management fee, and with virtually no trading of stocks through those helpers that we mentioned in Chapter 1? Why not indeed? The next chapter will explain this idea further. Don't take my word for it. Beginning as far back as 1995, Tyler Matheson, then executive editor of Money, conceded the point. For nearly 2 decades, John Bogle, the tart-tongued chairman of the Vanguard Group, has preached the virtues of index funds, those boring portfolios that aim to match the performance of a market barometer. And for much of that time, millions of fund investors, not to mention dozens of financial journalists including this one, basically ignored him. Sure, we recognize the intrinsic merits of index funds, such as low annual expenses, and because the funds keep turnover to a minimum, tiny transaction costs. Moreover, because index fund managers convert paper profits into realized gains less frequently than do the skippers of actively managed funds, shareholders pay less tax each year to Uncle Sam. To be sure, those 3 advantages form a trio as impressive as Domingo, Pavarotti, and Carreras. Well, Jack, we were wrong. You win. Settling for average is good enough, at least for a substantial portion of most investors' stock and bond portfolios. In fact, more often than not, aiming for benchmark matching returns through index funds assures shareholders of a better-than-average chance of outperforming the typical managed stock or bond portfolio. It's the paradox of fund investing today. Gunning for average is your best shot at finishing above average. We've come around to agreeing with the sometimes prickly, always provocative fund exec known to admirers and detractors alike as St. Jack. Indexing should form the core of most investors' fund portfolios. So, here's to you, Jack. You have a right to call it, as you recently did in a booklet you wrote, The Triumph of Indexing. Thanks, Tyler. Chapter 12. Selecting index funds that own the entire stock market. The majesty of simplicity. If low costs are good, and I don't think a single analyst, academic, or industry expert would disagree that low costs are good, why wouldn't it be logical to focus on the lowest cost funds of all, index funds that own the entire stock market? Today, several index funds carry expense ratios of as low as 0.1% or even less, and incur turnover costs that turn out to be zero. All-in costs of just 10 basis points per year, 80% lower even than the 90 basis points for the low-cost quartile of funds described in the previous chapter. And of course, it works. Witness the real-world superiority of the S&P 500 index fund over the average equity fund over the past 25 years and over the previous decade that you've seen in earlier chapters. The case for the success of indexing in the past is compelling and unarguable. And with the outlook for subdued returns on stocks during the decade ahead, let me conclude my anecdotal stroll through the relentless rules of humble arithmetic with a final statistical example that suggests what the future may hold. We can in fact use statistics designed to project the odds that a passively managed index fund will outpace an actively managed equity fund over various time periods. The complex exercise is called Monte Carlo simulation. Footnote: basically, a Monte Carlo simulation takes all of the monthly returns earned by stocks over a long period, even a full century, scrambles them randomly, and then computes the annual rates of return generated by each of the thousands of hypothetical portfolios. What it does is make a few simple assumptions about the volatility of equity fund returns and the extent to which they vary from the returns earned in the stock market, as well as an assumption about the all-in costs of equity investing. The particular example I now present assumes that index fund costs will run to 0.25% per year, and that the costs of active management will run to 2% per year. Note that this is a larger cost than available through the lowest cost index funds. Every day he tells you what he thinks your interest is worth, and furthermore, offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems little short of silly. If you are a prudent investor, will you let Mr. Market's daily communication determine your view as the value of your $1,000 interest in the enterprise? Only in case you agree with him, or in case you want to trade with him. Most of the time, you will be wiser to form your own ideas of the value of your holdings. The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Chapter 3. Casting Your Lot with Business. Occam's Razor Writ Large. So how do you cast your lot with business? Simply by buying a portfolio that owns the shares of every business in America and then holding it forever. It's a simple concept that guarantees that you will win the investment game played by most other investors who, as a group, are guaranteed to lose. Please don't equate simplicity with stupidity. Way back in 1320, William of Ockham expressed it well, essentially setting forth the precept that, when there are multiple solutions to a problem, choose the simplest one. William of Ockham actually expressed it more elegantly. Entities should not be multiplied unnecessarily. But the point is unmistakable. And so Occam's razor came to represent a major principle of scientific inquiry. And so, too, is owning all of U.S. business the essence of simplicity achieved by holding the stock market portfolio. For most of the past 80 years, the accepted stock market portfolio was represented by the Standard & Poor's 500 Stock Index, created in 1926 and now holding a list of 500 stocks, essentially composed of America's 500 largest corporations, weighted by the value of their market capitalizations. The index originally included just 90 companies, rising to 500 in 1957.
In recent years, these 500 stocks have represented about 80% of the market value of all U.S. stocks. The beauty of a cap-weighted index is that it automatically adjusts to changing stock prices and never asks to buy and sell stocks for that reason. With the enormous growth of corporate pension funds during the 1950 to 1990 era, it was an ideal measurement standard, the benchmark or hurdle rate that would be the comparative standard for how their professional managers were performing. Today, the S&P 500 remains a valid standard against which to compare the returns earned by the professional managers of pension funds and mutual funds. In 1970, an even more comprehensive measure of the U.S. stock market was developed. Originally called the Wilshire 5000, it is now named the Dow Jones Wilshire Total Stock Market Index. It includes some 4,971 stocks, including the 500 stocks in the S&P index. However, because its component stocks too are weighted by their market capitalization, those remaining 4,471 stocks account for only about 20% of its value. Nonetheless, this broadest of all U.S. stock indexes is the best measure of the aggregate value of stocks, and therefore a superb measure of the returns earned in U.S. stocks by all investors as a group. Of course, the two indexes have very similar composition. Consider, for example, the 12 largest stocks in each and their weight in the construction of each index. It is hardly surprising that the two indexes have earned returns that are in lockstep with one another. The Center for Research in Security Prices at the University of Chicago has gone back to 1926 and calculated the returns earned by all U.S. stocks. Its data since 1970 have provided a virtually perfect match to the Dow Jones Wilshire Total Stock Market Index. In fact, returns of the two indexes parallel one another with near precision. From 1928 through 2006, you can hardly tell them apart. For the full period, the average annual return on the S&P 500 was 10.3%. The return on the total stock market was 10.1%. Of course, this represents what we call a period-dependent outcome. Everything depends on the starting date and the ending date. If we began the comparison at the beginning of 1930, instead of 1926, for example, the returns of the two were identical, 9.9% per year. Yes, there are variations over the interim periods. The S&P 500 was much the stronger, for example, in 1982 through 1990, when its annual return of 15.6% outpaced the total market index return of 14%. But in recent years, 1998 through 2006, small and mid-cap stocks did better, and the total market index return of 3.4% per year nicely exceeded the 2.4% return of the S&P 500. But with a long-term correlation of 0.98 between the returns of the indexes, 1.0 is perfect correlation, there is little to choose between them. Whichever measure we use, it should now be obvious that the returns earned by the publicly held corporations that compose the U.S. stock market must of necessity equal the aggregate gross returns earned by all investors in that market as a group. Equally obvious, as we'll learn in detail in the next chapter, the net returns earned by these investors must of necessity fall short of those aggregate gross returns by the amount of intermediation costs they incur. Thus, the reality of investing is that investors as a group must lose to the returns earned by business. This reality is obvious. While owning the stock market over the long term is a winner's game, beating the stock market is a loser's game. Such an all-market fund is guaranteed to outpace over time the returns earned by equity investors as a group. Once you recognize this fact, you can see that the index fund is guaranteed to win not only over time, but every year and every month and week, even every minute of the day. Because no matter how long or short the time frame, yes, the gross return in the stock market, minus intermediation costs, equals the net return earned by investors as a group. If the data do not prove that indexing wins, well, the data are wrong. Over the short term, however, it doesn't always look as if the S&P 500 index, still the most common basis of comparison for mutual funds and pension plans, or the Dow Jones Wilshire 5000 index is winning. That's because there is no possible way to calculate the returns earned by the millions of diverse participants, amateur and professional alike, Americans and investors in foreign countries, in the U.S. stock market. So what we do in the mutual fund field is calculate the returns of the various funds, counting each fund rather than each fund's assets as one entry. Since there are lots of small cap and mid cap funds, usually with relatively modest asset bases, they make a disproportionate impact on the data. When small and mid cap funds are leading the total market, the all market index fund seems to lag. When small and mid cap stocks are lagging the market, the index fund looks formidable indeed. Nonetheless, the exercise of calculating how the returns earned by the stock market itself compares with returns earned by the average equity fund is both illuminating and persuasive. If we compare the results of what are described as large-cap core funds with the returns of the S&P 500, because of its market capitalization weightings, a large-cap core index, the advantage of the index itself is impressive. During the 37-year period, 1969 to 2006, the S&P 500 index fell into the bottom quartile in only 2 years, and has not done so since 1979. The index has outpaced the average fund in 26 of the remaining 35 years, including 11 of the past 15 years. Its average ranking was in the 58th percentile.